Greetings of the day. Myself, Raghavendra Babu, Department of Commerce, Kristu Jayanti College, Assistant Professor. Okay, today we are going to discuss about capital structure analysis. It is one of the important concepts under financial management. Let's go to the concept. Capital structure analysis. Okay, it is an important concept under financial management. Generally, financial management deals with financial decisions, investment decisions, dividend decisions, and capital structure decisions is one of the important concept under financial decisions. So, financial decisions generally deals with capital structure analysis. So capital structure refers to mix of different sources of funds including equity, debt used by a company to finance its operations and investments. Basically, it is a combination of various long-term sources of finance. It includes equity shares, preference shares and debentures. So it represents the way that a company finances its assets and its essentials in determining its financial health and risk profile. So capital structure varies across industries. For a company involved in mining or petroleum and oil extraction, a high debt ratio is not suitable. But some industries like insurance or banking have a high amount of debt as a part of their capital structure because mining or petroleum industries requires huge amount of capital and company raise capital in the form of debentures, so company is not able to repay immediately because debentures is having very less or short period maturity period. Because of that, it is not suitable for mining or petroleum or oil extraction industries. Like insurance or banking industries, a high amount of debt as a part of their capital structure because it is having short maturity period and company is having income generating capacity is very high, so that company can manage debentures. Okay, let's go to the next components of capital structure. So what are the various components of capital structure? It includes equity share capital, debenture capital, preference share capital, retained earnings. So what is meant by equity? Equity share capital is also known as risk capital. Equity shareholders are the owners of the company. They don't have any maturity period. So equity shareholders enjoy voting rights. The other source of finance includes debentures, preference shares and retained earnings. See, how you are going to analyze the capital structure, there are three types of analysis. One is leverages, weighted average cost of capital, EBIT and EPS analysis. So first we are going to discuss about leverages. So what is meant by leverage? It's like a gear. Leverage means gear. So we are going to compare with the automobile. So in automobile, so the action of lever or the mechanical advantage gained by it. The term leverage generally refers to circumstances which bring about an increase in income volatility. So in finance, leverage is the use of borrowed funds to increase the potential return on an investment. So in finance, so leverage is comparing to the debentures. So in debentures, you're going to apply the force on debentures and the benefit of this is reflected in the form of high returns to equity shareholders. So there are three types of leverages: operating leverage, financial leverage and combined leverage. So if company having more debentures, so financial leverage increases. So what is financial leverage? So financial leverage is nothing but financial risk. So what is operating leverage? Operating leverage is nothing but business risk. So it is a combination of business risk and financial risk is about combined leverage. So what is operating leverage? So operating leverage shows the relationship between contribution and EBIT. What is contribution? So generally the company is going to generate revenue. So that is through sales. So you are going to deduct variable cost from the sales, that is only known as contribution. Because of changes in the variable cost, so there is a change in the contribution. Because of the change in the fixed cost, the EBIT increases or decreases. Because of that, the business risk increase or decrease. So operating leverage shows the relationship between contribution and EBIT. So that is the formula for calculating operating leverage is contribution by EBIT. Next, financial leverage. What is meant by financial leverage? So financial leverage shows the relationship between EBIT and EBT. EBT is also known as taxable income. So EBIT is nothing but earnings before interest and tax. So if you are deducting variable cost from the sales, you will get contribution. In the contribution, you are going to deduct fixed cost. You are going to get earnings before interest and tax. It is also known as operating profit. If company is having more EBIT, now you are deducting the interest from the EBIT, you will get EBT. The relationship between EBIT and EBT is the interest on debentures. If company is having more interest on debentures, the financial risk increases, the financial burden increases. The main aim of any financial manager to balance the equity and debentures. If company is having a balance between equity and debentures, the financial burden reduces. So next is combined leverage. So combined leverage shows the relationship between contribution and EBT. Contribution is nothing but changes in sales because of the variable cost, and EBT is nothing but earnings before tax. It is also known as taxable income. So combined leverage shows the relationship between operating leverage and the business leverage. So that is financial leverage. So combined leverage is the formula is contribution divided by EBT. So if company is balancing between the financial leverage and operating leverage, automatically the risk in the organization reduces. Thank you.